Welcome to Breaking News at Trading Moves. Today we're looking at a development in the financial data world, specifically focusing on how a recent announcement changes the way credit scores get sold for mortgages.
That's right. We're examining Fair Isaac, the FICO score company. They've decided to restructure how their score is licensed for mortgage lending.
Okay.
And this isn't just tweaking prices. It's a move that pretty quickly sets up some winners and, well, some losers in the market.
So the main thing for you, the listeners, to get a handle on how FICO is now offering this direct-to-reseller licensing program for mortgage scores. It basically bypasses that traditional relationship, the one FICO had for years with the big credit reporting agencies.
Yeah, the old way.
Let's start right there with the mechanics of the change. For a long time, FICO scores moved through a specific channel. Can you walk us through how that old pass-through model worked and what FICO's doing now?
Sure. Think of the old setup, almost like a distribution chain. FICO made the product the score and sold it wholesale to the distributors. Those are the credit bureaus.
Yeah.
Equifax, EFX and TransUnion, TRU.
Right.
The bureaus then took that score, bundled it maybe with their data, their delivery system, and crucially, they added a markup before selling it on to the mortgage lender.
So they weren't just conduits. They added value, sure, but also a profit margin specifically on the FICO score part.
Exactly. Under that old system, the wholesale cost for just the FICO score piece was, well, pretty low, often cited around, say, $4.95. Something like that.
Okay, under $5.
Yeah, but then the bureaus would layer on their markup. Sometimes that could double or even triple the price the lender ended up paying, depending on their deal.
So what's the alternative FICO's put out there now?
FICO, that's FICO ticker, is essentially saying we'll sell directly to you, the lender. They're offering new licensing options. It looks like two main paths, either a flat price, maybe around $10 per score, seems to be the number floating around, or possibly a performance-based price, maybe tied somehow to loan volume.
Hold on. If the wholesale was under $5, but the bureaus marked it up, and now FICO is asking 10 flat, how is that a saving?
Because the total price the lender was paying the bureau after that markup was often quite a bit higher than $10.
I see.
This move is really about FICO capturing the value, the economics that the bureaus used to get from that markup. The analysis suggests this new direct pricing could cut lender costs by as much as 50%. Per score.
50% on a cost like credit pulls, that's a big number, especially for lenders processing thousands of applications. It makes sense why this is getting attention.
Yeah, that kind of cost saving is really noticeable in a high-volume business like mortgage lending. And it brings a lot more transparency, too. Lenders now see exactly what they pay FICO versus what they pay for the bureau's delivery services.
Okay, let's talk about who gets hurt here, at least initially. Looking at the market reaction, there's a pretty clear group taking a hit. Who are the main losers?
Yeah, the immediate losers are definitely the credit bureaus, mainly Equifax, EFX, and TransUnion, TRU. The reason's simple. FICO is going after that high-margin revenue they used to make just by marking up FICO scores sold into the mortgage process.
That lost revenue on each score pull must add up fast. Is there any sense of what that margin loss means for their bottom line?
Analysts are flagging a potential risk, maybe a 10 to 15% profit hit for these companies, specifically related to this. You have to remember, mortgage scoring revenue is, it's a very profitable part of their business, especially in the U.S.
10 to 15% compression on that profit segment.
Yep.
Yeah, the market's going to notice that.
And, it's not just the bureaus themselves. This could also affect any other vendors or platforms whose business model relied on getting a piece of that bureau score resale markup in mortgages. But EFX and TRU are the main listed companies feeling this directly.
All right, let's flip to the other side then, the positive side. Where do the savings go? Who benefits when FICO kind of cuts out that middle layer?
We're seeing about three main groups emerge as beneficiaries. First, maybe obviously, are credit scoring platforms themselves. FICO clearly benefits. They get to keep revenue that bureaus used to take. Their stock reacted positively to this news, as you might expect.
Right, they capture more value and defend their turf. Are there other platforms involved in lending that game?
Yes. Another one mentioned is MeridianLink, MLNK. They provide loan origination, software LOS, and tools for credit data integration.
Okay.
So as lenders switch to getting scores directly, platforms like MeridianLink, MLNK that help make that integration smooth for their clients, they could benefit from this new setup.
Makes sense. So beyond the software and data folks, the next logical winners would be the companies actually making the loans, right? The mortgage originators and brokers.
Absolutely. Companies like Rocket Companies, RKT, and UWM Holdings, UWMC, for them it's pretty straightforward economics. Lower cost per score. If you're a high-volume originator pulling thousands, maybe tens of thousands of scores a month, cutting that cost per score, potentially by half, that flows right into better margins on each loan.
Especially now, right? With rates where they are, margins are tight. Any cost reduction like that is welcome. Helps their efficiency too.
Exactly. Lower data costs might mean they can check more potential borrowers up front or just bank the savings. It improves their operating margin without even touching the rate they offer the customer.
Okay, and there's a third category you mentioned, platforms that use credit checks early on just to qualify leads.
Yeah, the online loan marketplaces. Think about platforms like LendingTree. They buy millions of credit pulls every year just for, lead qualification, matching borrowers and lenders.
Right, before a full application even happens.
Exactly. So seeing a 40, maybe 50% drop in that cost, that really helps their basic unit economics. It's a major operational expense for them.
That seems like a direct boost to their cost structure. Their whole model kind of depends on managing those data pool costs effectively.
Definitely. And it's worth noting, Rocket's marketplace side, RKT again, also benefits from this same dynamic. It gives larger players with scale and advantage. Now, it's important to see this FICO move wasn't just random. It seems like a calculated response to, well, external factors.
What external factors? What prompted FICO, the dominant player, to shake up a system that worked for them for so long?
It looks like it comes down to regulatory pressure.
Yeah.
Regulators have been pushing for more competition in mortgage scoring. Specifically, the FHFA, the Federal Housing Finance Agency.
Ah, right. They oversee Fannie Mae and Freddie Mac.
Exactly. And the FHFA has been working to allow alternative credit score models like VantageScore to be used for mortgages sold to Fannie and Freddie, the GSEs.
So the moment the FHFA opens the door to another score model, FICO suddenly faces real competition in its most important market.
That's the idea. FICO is the standard, yeah, but if lenders get a choice, especially a potentially cheaper one, FICO's position looks a bit less secure. So FICO going direct, offering these big cost cuts, it looks like a countermove, a way to make their own score much cheaper and more transparent for lenders, reinforcing its position before competitors gain a strong foothold in those GSE-backed loans.
So instead of waiting to compete on price later, they acted first to lower the cost themselves.
Seems like a classic defensive play.
Yeah.
Maybe give up a bit of margin per score to keep the overall volume and make it harder for bureaus to bundle in a competitor.
Okay, let's wrap this up. To summarize, we have FICO, making a strategic play to control its pricing and relationships better. This puts immediate pressure on Equifax, EFX, and TransUnion, TRU. But it also gives a potentially big cost advantage to lenders and marketplaces like Rocket, RKT, and LendingTree.
Yeah, it really highlights how sometimes regulatory actions, even those aimed at fostering competition, can lead established players to make big moves themselves, offering better deals directly to their customers to protect their business.
So, the final provocative thought we'll leave you with today is this. If FICO really does cut data costs for lenders by up to 50%, where does that saving go? Does it eventually get passed on to you, the consumer, maybe through lower fees or slightly better rates? Or does it just boost the lender's profit margins?
Something to think about.
Before we sign off, a quick reminder. This discussion is based purely on the information available from the author's analysis of this market event. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author. Thank you for tuning in to Breaking News to Trading Moves.